Chief Executive Officer at SBI-SG Global Securities Private Limited, a joint venture between India's largest bank, of course, State Bank of India, and Society General Securities Services, SGSS, one of the world's leading global custodians. He is Chief General Manager on deputation from SBI to SBI-SG. In his previous role, he was heading the Haryana state in the Chandigarh circle. He joined SBI in February 1987 as a probationary officer. Mr. Naryani brings with him vast experience across all areas of banking and has worked in various capacities and functions during his tenure with SBI. He is a seasoned treasury professional and has headed the regional dealing room at SBI Delhi and international treasury at SBI Bahrain. In his capacity as Deputy General Manager, Interest Rate Markets at SBI Global Markets, Mumbai, he spearheaded the bank's rupee treasury. He was a member of the Board of Directors at Fixed Income Money Market and Derivatives Association of India, FIMDA, and also a part of various committees of SEBI on municipal bonds and corporate bonds. He led and managed planning, performance monitoring and review, capital adequacy and investor relationship for the bank from 2014 to 2016. He holds a master's degree in computer science and a master in computer applications. He has completed an executive program in management from IIT Mumbai and a program in leadership development from the Indian School of Business, Hyderabad. Sir, I welcome you on stage to moderate this panel. Thank you so much, sir. So while Mr. Naryani will provide a more elaborate description of his panelists, I am happy to invite Takeshi Ebihara, Founding General Partner, Rebright Partners. Thank you so much for coming all the way from Japan for us. Ritesh Banglani, Partners, Stellaris Venture Partners, all the way from Bangalore. Arihant Patni, Managing Director, Ideaspring Capital. Again, he is from Mumbai and Bangalore. So, and then Kunjan, Chikhlikar, Head, RPG Ventures, very much in Mumbai. And Seema, Jhingan, Partner, LexCounsel from Delhi. Thank you. Over to you, sir, as you can describe the panel further. Thank you so much.
Good evening to all of you. Thanks, Arun, for the kind introduction. It is a great pleasure to moderate a panel of Asian venture capital stalwarts. It is an opportunity for all of us present here to listen to these stalwarts speak about where, who, when, why of the happenings in VC segment. Last 4 to 5 years have seen lots of interest getting generated in VC segment. On one hand, FY15 was the year of record investments, and on the other, FY17 saw the major exits and SoftBank investing. Though the VC investments have been coming down since FY15, there have been lots of major trend-changing moves. To deliberate on these, joining me on the panel are Mr. Ritesh Banglani, his partner in Stellaris Venture Partners. Ritesh has a strong interest in companies solving uniquely Indian problems and those that apply new technology to their industry for the first time. He invests in technology companies in healthcare, travel, and financial services. Prior to Stellaris, Ritesh was a partner at Arihant Ventures. Mr. Arihant Patni, he is Managing Director, Ideaspring Capital. He is an entrepreneur, financial advisor, venture capitalist with extensive experience in diverse areas such as IT services, infrastructure, business development, marketing, and wealth management. Arihant serves as Managing Director of Ideaspring Capital, an early-stage VC fund that invests in companies building technology product solutions for the enterprise space. It is a fund for entrepreneurs, run by entrepreneurs. He is also Managing Director of Patni Financial Advisors, a wealth management company, and Hive Technologies, a platform that invests in data analytics and data science, big data companies. A big round of applause. We also have with us today Mr. Takeshi Ebihara. He started his career in 1994 at JAFCO which is the largest venture capital PE firm in Japan. He has been in the industry for more than 23 years as venture capitalist and as serial entrepreneur. Ebihara is now the founding general partner of Rebright Brothers, an early-stage venture capital firm with a focus on India and Southeast Asia. A big round of applause for it. We also have with us Mr. Kunjan Chikhlikar. He heads RPG Ventures, the innovation-oriented corporate venture capital and incubation team of the RPG Group. Prior to joining RPG Ventures, he had worked at leading private equity firms including Fidelity Growth Partners India, Lighthouse Funds, and IDFC Private Equity. Kunjan had previously worked in US with Common Fund Asset Management. Big round of applause for him. And we have with us the tax expert, the legal expert, Ms. Seema Jhingan. She is a senior partner and co-founder of LexCounsel Law Offices. Has over 23 years of experience. She has extensively advised in areas including mergers, acquisition, venture capital, private equity, defense, aviation, education laws, telecom, media, entertainment, software, information technology, general corporate and commercial. A big round of applause. She has an expertise in representing legal matters related to collaborative alliances and joint ventures, cross-border mergers, acquisitions, corporate structuring, private equity investments, divestments, shareholders matters, minority protection and exit options, private placements, exchange control, capital repatriation, and antitrust issues. Did I forget anything? So, warm welcome to all our panelists. During the panel discussion, it will be my endeavor to engage with panelists to understand the emerging industry trends better. Understand from them their different investing styles, challenges that they face on fundraising, and about the evolving Indian VC ecosystem. Additionally, for the benefit of our startup founders and our audience, we also will give you a perspective on legalities pertaining to VC investments and exits. We hope to have enough time at the end of the discussion for an engaging question and answer session where you may pose your questions to our panelists. So to start with, my first question I would like to address to Ritesh, Arihant, Kunjan and Ebihara. See, according to the data from Venture Intelligence is the sole supplier of data and it has a lot of, a big data bank. So according to data from Venture Intelligence, venture capital firms have made 361 investments in India in 2017. The information technology and IT-enabled sectors has seen majority of the deals in 2017. I would like to understand from you, what are some of the areas that most excite you, that you are most bullish on for opportunities in 2018? To start with Ritesh.
Hi everyone. Very quick background so you have the context for the rest of the panel discussion. Stellaris Venture Partners is a new fund focused on Series A and B-Series A investments. We are based in Bangalore and we have a $100 million corpus. My partners and I have had the opportunity to participate in the venture ecosystem in India for the last decade. We have been observing trends and are trying to create a firm which is in line with the current trends in the venture ecosystem. To answer your question, Sanjeev, we do not think in terms of particular industry sectors because we believe that the India tech opportunity is very broad and horizontal. There are a few investment themes that we are bullish about, and I can quickly try to summarize some of those. One of the areas we are most bullish on is services, products, content, and user experience built for the next 300 million internet users in India. We believe that the current services on the mobile as well as online in India have been all built with the first 50 million users in mind. I can elaborate later in the panel why we believe that the next set of services targeting the next 300 million users who are all online today, but are predominantly using Facebook and WhatsApp on their mobiles, are going to be very different. And we believe that that's a massive opportunity for local firms and also a very defensible opportunity. Another theme that we are extremely bullish about is the ability to technology enable the SME in the country. We believe that with the mobile penetration being what it is not just consumers who have technology in their hands, it's also the SMEs. And for the first time, it has become possible not only to reach, but also to monetize the SME. And the third area, the final area I'd like to talk about is global software sales from India. Again, because of some of the trends, whether it is SaaS, whether it is sachetization of software, and whether it is delivery of software over the internet, we believe that it is now possible in the last 3 to 5 years, it has become possible to sell software in small packets over the internet, which basically addresses the biggest concern that Indian software companies have had over the years, which is while they have been able to create good software, they have not had the sales capacity to sell. So these are some of the things we are focusing on, but in terms of sectors, we are relatively broad. So we do financial services, healthcare, travel, content, and several other verticals.
Thank you, Ritesh. Arihant, you would like to add something?
Sure, thank you, and thanks, Ritesh. And like Ritesh, just to give you a little bit of context, so my DNA is in the IT services space. We had a family business called Patni Computers that we sold 6 or 7 years ago, and then after that got into the whole venture space, one through our family office, and also by anchoring various funds in certain domains, and therefore in the venture capital model. So the 3 funds that we have is Nirvana Ventures, which is in the e-commerce space, and 2 funds, the Hive, which is the big data fund, and both which are in the enterprise and B2B space. So just to build on that, I think consumer internet and what Ritesh mentioned about the 300, 400 million smartphone or cell phone users in India is a very exciting opportunity. Personally, what sort of interests me right now, because of our active fund thesis, is companies and entrepreneurs that are trying to build product innovation out of India. So, folks that are from the whole Amazon, Microsoft, NetApp ecosystem that know or have aspiration to build global products to solve enterprise problems. So this could be sort of software as a service, solutions. It could be enterprise product, or it could be any platform as a service kind of play as well. We are very excited with trends in augmented reality, virtual reality, deep learning, Internet of Things. We've made investments in all those different areas. And I would like to caveat that by saying that we come in early. So, our check size is really the first institutional round that would come into the company. And we really sort of like to roll up our sleeves, work alongside the companies, founders that we invest in, and help them get to the next level. So the last tagline that we have for entrepreneurs by entrepreneurs it really stands true, because the businesses that we come into are not necessarily fully sorted or solved, right? There are a lot of open-ended items, there are a lot of things that yet need to be discovered, and our thesis is we will discover them along with the founders. And therefore the team and the space plays a very important role in how we pick companies versus the metrics that they have already achieved.
Thank you, great. Kunjan, would you like to add something?
Hi everybody, good to see everybody today. So just a matter of 1 minute intro. So I lead RPG Ventures. We are sort of new ventures arm of the RPG group, which is around legacy. We do two parts to our model. We incubate businesses, as in we literally set them up. These are our businesses, and we can take them off the ground. And the second part is basically invest in early stage businesses. The whole, just tell you why I'm excited about two themes, because of the purpose why RPG Ventures was set up. And I think it was set up to just literally sort of enable the RPG group to build ownership in new age futuristic businesses. That's sort of our mandate, and which we believe are real as of now. So two themes that we've been sort of pursuing very religiously over the last year or so are cybersecurity and artificial intelligence. Because we genuinely believe that basically these are two important areas that are sort of the need of the hour and will become eventually pretty large. For the last year or so, we've already invested in a business in the cybersecurity space, and I believe the need is real because it's sort of, as everything sort of moves on the cloud, and everybody knows basically the kind of breaches on data and security that are happening on a weekly and monthly basis now. It's become too much of a threat, as a nuisance as well. Financial leakages, personal theft. The importance of cybersecurity is very much there right now, and we've interestingly found a business which is sort of built in business based in India but catering to the global market as well. And across both cybersecurity and artificial intelligence, again, we're sort of looking at businesses out of India, but obviously not looking at just the Indian market, because again, adoption and sort of the understanding the need for some of these use cases is definitely more so in the US and Europe compared to the Indian market right now. The other areas, artificial intelligence, again, sort of, we've been doing a lot of work in that space as well. I think the drivers are very clear. I think the kind of data availability which is there today, and just how it exponentially sort of grows every day and every week is humongous. So, which was just not there 10 years ago. And second thing is basically computational power, and we've seen sort of what the NVIDIAs of the world, etc., have sort of done over the last couple of years with their businesses and stuff. So I think it just, you put those two together, and then you just genuinely have the power that you can build artificially intelligent computers or models. And we're seeing a lot of sort of use cases where they're sort of even beating humans. I think the whole AlphaGo, Google was a great sort of example. Again, in artificial intelligence, we are just sort of not restricting ourselves to India and global markets, and just deep use cases. I think this whole sort of ability to, for example, disrupt the whole call center, BPO services, and sort of have maybe virtual assistants out there is superb, and it's a great idea. But there are various such examples where artificial intelligence can really sort of, be a real business case. So, from our perspective, I think these two are the themes that we sort of feel pretty good about right now, and we've been doing a lot of work in terms of identifying businesses out there.
Yeah, good, Kunjan, we agree. Nowadays, AI and cybersecurity are the two main focus areas which need a lot of attention, investment, development. And so we come to Ebihara-san. So your views on this, if you would like to add something?
To follow this gentleman's format, I'd like to do the quick self-introduction. So Rebright partner is the we manage the 4 funds now, and then those funds are backed by the mostly Japanese corporate, like the manufacturing sector to the banking sector. And then the investment allocation purely goes to the South Asian emerging market, including here in India. So we made so far 11 investments here in India, and dozens of the investment in Southeast Asia, especially for Indonesia. And talking about this point, what we are bullish for is I've been a very big fan of the concept of the digital transformation. So we believe that technology is going to redefine all of the industry or our life every single 5 years. In that sense, we are quite bullish to invest in every single sector, especially for the large sector like financial, healthcare, transportation, etc. And talking about the dimension of the technology, definitely, as those gentlemen says, the artificial intelligence is getting a commodity now. So all of the giants like the Google, Facebook is now opening their platform to make the use the artificial intelligence engine to make the business process much more efficiently, etc. So artificial intelligence plus largest sectors like auto, healthcare. That is a very good example for us to invest. For example, one of the recent investment is the company called DocSup. That's the healthcare plus AI. They do a remote doctor consultation via the mobile application. But the 70% of the transaction done by the AI. Because 70% of the disease is just get a cough and something like that. So it's quite easy. So that's a good example. Another one is the telematics, or now the 4G is now getting commoditized in this country as well. So that the telematics plus transportation makes our investment into the company called the LexCounsel. So that's also the disruption of the logistics, relatively legacy industry by the technology. So we do this kind of a digital transformation type of investment. We are still bullish, and then maybe we'll keep doing this kind of investment for the 2018 as well.
Great. Thank you, Abihara-san. Now, coming back to Ritesh and Arihant. Since 2015, if we see VC industry, there are two trends that we see that these trends are emerging. Now, whether they are trends or not, please comment on that. 2015 saw the peak of investments. After that, 2016, the investments came down. 17, they came down further. That is one. So, is this coming down of VC investments, do you see it as a trend? If yes, then you are view on it. And then over the last 2 years, most of the capital is going to India tech companies that seem to have been grabbed by mature and scaled up companies like Flipkart, Ola. These formerly startup companies have helped attract record private equity funding to the country. So, what is your reading about this phenomenon?
So, very interesting observations, Sanjeev. I'd like to mention a few trends that are resulting in the two outcomes that you mentioned. See, the first trend is, I would say, the baseline effect. The investments in early stage are down relative to, or even the absolute investment amounts are down relative to the heydays of 2014 and 15. And for those in the room that have forgotten, I do want to refresh everyone's memory of what was happening in those 2 years. Hedge funds started playing VC. Series A rounds started creeping up to $10-12 million in size. Basically, it was too much capital chasing too few opportunities, and at the risk of annoying a part of the audience here, investment bankers started turning entrepreneur, which to me is the surest sign of a bubble. But I do think that if you look at the long-term trend, if you look at the trend from the 10-year trend, I would argue that the 10-year trend is still positive. And we had a massive peak in 2014 and 15, and then maybe a little bit of a trough in 2016 as a result of the excesses of those years. But we do see that the broad trend in terms of both number of companies and the amount of capital being positive through these tumultuous years as well. The second trend I would like to point out is in the venture capital industry. So I started in venture capital in 2007 and will be completing 11 years in a couple of months' time. In 2007, the number of VCs that were there, and if you compare the number of VCs today, and I'm excluding micro funds of $20-30 million or so, I would say the broad number is approximately the same. There are a few VC funds that have gotten established. We have gotten established very recently with the couple of funds that Arihant is involved in. They have gotten established in the last couple of years. But a lot of funds have also left the country since then. Particularly what I would call the fly-in and fly-out funds. People who were investing from a global pool of capital into India without having a long-term presence in India, they have all left. Greylock had an office in India, Battery Ventures had an office in India, Canaan Partners had an office in India. All of these firms have left the country. So broadly, there used to be about 10 funds 10 years ago. There are probably 12 funds today in Series A and beyond. However, the amount of entrepreneurial activity has gone up, I would say, at least 3 to 4x in this 10-year period. And as a result, what has happened is that the same funds that have existed for a long time have become larger and larger. I'll give you a few examples. Accent Partners started with a $60 million fund. The current fund is $450 million. Nobody knows how large Sequoia was when they started in India, but their current fund is $950 million. SAFE is at $350 million. Nexus is at $450 million. Kalari is at $300 million. So what has happened is that all these funds, as a result of the larger funds that they have become, have all become multi-stage funds. So there are very few pure Series A or pure early stage funds in the country. And we believe that the right size of fund for Series A is in the, I would say, $75 to $150 million range, because that's the available opportunity in the country in purely Series A. And as a result, a lot of these larger funds are seeing opportunity in later stages, resulting in a Series A crunch, which is also in part responsible for the outcome that Sanjeev was mentioning, that Series A rounds have not increased to the extent that we would have expected them to increase. I'll mention a couple of other trends at the risk of stealing Arihant's thunder. I think, the other outcome you mentioned, Sanjeev, was around 3 or 4 large companies having been established who were formerly startups. To coin a term, just like in China we have the BAT, Baidu, Alibaba and Tencent, we are seeing the emergence of the big 3 in India as well, that I would like to call OFP, Ola, Flipkart and Paytm. What we have seen in the last 3 years is these big 3 making strategic investments of their own and effectively playing VC. Whether they should be doing it with venture capital money or not is a separate question. But is it beneficial for the startup ecosystem in India? Absolutely so. I mean, these larger, I won't call them startups anymore, these mid-sized companies, homegrown tech companies, bring a lot to the table for startups. They bring their market reach, they bring their investor reach, they bring their management bandwidth, and very importantly, given that all of these are consumer companies, they bring a lot of data to the table to their investing companies. So we see that as a very major trend as a result of these companies having raised a lot of capital. We believe that over the next 10 years, these 3 and maybe a couple more will join this list, will become significant participants in the startup ecosystem as investors, as acquirers, as business partners, and broadly we see that as a positive trend in the industry. And the last bit that I would mention is angel investing. We have seen actually a full cycle in angel investing in the last 4 years or so. Certainly our data and our observations on the ground suggest that angel investments are down in the country. And our analysis is that that is because of the realities of angel investment sinking in over the last 3 years. Angel investment requires diversification, angel investment requires the ability to live with significant illiquidity, requires long holding periods, requires the ability to do diligence and manage a portfolio, which a lot of the, I would say, opportunistic angels that emerged in 2014 and 15 have not been able to follow through on. So, I mean, all are good reasons, I would say, for the fall in angel investment. My wish list would include more angel funds so that the angels, instead of taking all the risk individually, can pool their capital and actually make smarter investment decisions and be more risk-seeking than we have seen as individual angels. So broadly, these are the few trends that we are seeing that have led to the outcomes that Sanjeev was describing.
Thank you, Ritesh.
So I think fantastic points, and just very quickly to kind of top it off, I think that we've been in the market as a family office since 2002, 2003. And to Ritesh's point, I think the whole venture capital / private equity ecosystem, and certainly the venture capital more than the private equity ecosystem, has been fairly new. So we're still seeing cycles that are emanating. We've seen the e-commerce cycle, we're seeing now a little bit of the SaaS cycle. So one thing to keep in mind is that, unlike the US, where there is decades of data and decades of people doing this as a business, with India we're still young. And I think with India, entrepreneurship and the startup culture in itself is really young. From a social aspect, from a business opportunity aspect. Therefore, it's very early years, and as Ritesh said, the baseline effect plays a big role in determining whether 1 year was particularly good or bad in terms of the number of deals that went through. The other thing I wanted to point out is that very early in this startup cycle, we had access to a lot of easy money, and Ritesh mentioned investment bankers becoming entrepreneurs. I would flip it and say it's really scary when entrepreneurs become investors, right? So they actually move away from their traditional business and start looking at opportunities that are outside, and me included, by the way. But what's really, what we forgot at some point was just the fiscal prudence of things like unit economics, things like what do you do when the easy cash dries up. A lot of companies and big names fell into that chasm where they weren't able to attract capital from some of the funds that kind of fleetingly came through India and then went away. And also fundamentally, as an entrepreneur, to realize that it takes time to build a business. It takes 10 years to build a valuable business anywhere in the world, right? So if you're actually going out there and saying, okay, I'm going to just flip it on valuation year after year, it's eventually going to come bite you in the behind, and that's what's happened to a lot of companies. And we see that now in the ecosystem, where I feel both as investors, maybe angel investors, VC investors, early stage, as well as entrepreneurs, have kind of learned from this past cycle and have evolved. And I think we're seeing a little bit of maturity emanate in terms of founders having done more research in terms of the companies that they're trying to build, investors asking the right questions, and really trying to figure out the best sort of investor-founder match so that they can really build a more substantial company going forward. And I think these numbers will come back up. I think they will. The color of these numbers will look a little bit different year on year, depending on the spaces in which this opportunity lies. And yeah, I think it's definitely exciting times ahead, but a lot more still to cover.
So as you said, it takes 10 years at least, for a good deal to mature, and the purpose for which the investment has been made to be fulfilled. So maybe some good investments made in 2006, 2007, they are nearing their maturity, and now it's time to cash it, provide good returns to investors. Right. Anything you would like to say on this?
No, I think Ritesh, Arihant have covered it all. I think with just one point which sort of came out from both their sides is I think investors also have gotten a bit more cautious. So I think in 2014, 2015 they were just sort of spraying all over, and after sort of when reality struck and they saw a lot of write-offs and sort of these investments not working out pretty quickly within sort of a 12 to 18 month span, I think that's caused a lot of risk aversion. And that is exactly what is dampening the investment environment in this sort of pre-Series A, Series A space in 2016, 2017. But I agree that I think in the long term outlook is still positive, and I think deals will start coming back up again once you see some positivity and more discipline from investors as well, and therefore leading to hopefully better outcomes.
Yeah, keep holding. There's one question where I need your inputs. Kunjan, please, if you can give. There is another trend emerging. That is, the entry of large VC players, as we were discussing, like SoftBank, Alibaba, etc. So selling out to SoftBank, Alibaba, and other Asian strategic investors, this has produced best of the VC exits in 2017. Largest one was SoftBank, So these major investors are stepping into the Indian VC space and may have an impact on the competitive landscape and the way forward. If you have some comments on that.
So yeah, we saw SoftBank put a lot of money into Flipkart and giving an exit to Tiger. Alibaba sort of putting money into Paytm and Saif got a good exit over there. So that trend is very clear, but I think that trend is sort of in those super large ticket sizes, right? The 200 million, 300 million, 500 million, maybe $1 billion round as well. See, the space that I'm talking from my perspective, the space that RPG Ventures plays in is more sort of the pre-Series A, Series A space. So, even the competition is going up from these, foreign funds or foreign companies plowing their money into the Indian ecosystem. We don't see that because they won't be interested in sort of the 0 to 5 or 0 to $10 million space. So I think over there, there's still sort of, room for homegrown Indian funds, family offices to still be competitive. That's one. And I think, I don't think it's a bad thing for the Indian startup ecosystem because, if you have guys out there who can write $1 billion checks and give the earliest guys exits. So I'm sure sort of, when SoftBank plowed in $1 billion, they gave Tiger an exit, but I'm sure some of the guys who came into Flipkart and again, Series A, Series B stage as well, they must have gotten an exit. I know that, Seema got an exit completely from Snapdeal, whenever they exited from Snapdeal as well. So it is actually a good thing for the Series A, Series B investors. And I think, because then also from the company's perspective, I think it widens options. Right? So basically it's like, if Policy Bazaar tomorrow doesn't want to sort of do an IPO, and it's just there is somebody else out there, it could be a Tencent or whoever, or SoftBank, they can just go to and sort of, so it's, so there is availability of capital, I think it's a good thing, right? And, where are you going to sort of find Indian homegrown investors willing to write a $200, $300 million check? I think that money has to come from outside. So I don't see this in bad light at all, and, like I said, the space that we particularly play in, and for others in our space as well, I don't think we may face that coming.
Thank you. Ebihara sir, would you like to comment on this?
Including myself and maybe for those gentlemen as well, I don't think that any venture capital is competing with those giants. I sometimes prefer to use the phrase that I created, the new Seven Sisters. New Seven Sisters, 5 giants, including the Apple, Amazon, GAFA, plus Amazon and Tencent. Sorry, Alibaba and Tencent. And together with that, the SoftBank. That's the 8th, the giants. So they are the partner for the VCs, especially for if you say, maybe you can say the exit partner, or the later stage partner who will take the relay partner from the maybe early stage venture capital like us, later stage venture capital, AB venture capital like Jhingan, and to do they are typically take the at least Series C onwards. So we are partners, and also as he mentioned about the excess of liquidity. That's a chicken and egg problem. Maybe excess of the liquidity create those giants, or those giants is creating too much excess of the liquidity at this point. But that's the human nature. That's the history. It's meaningless to argue, discuss about that, right? But obviously that makes the price of the stocks incredibly increase. That's we cannot deny. But I don't think that's a bad thing. That's the evolution of things. So we, as an investor, as well as the entrepreneur, have to run faster than that. we have to create our frontier as well. So we as a venture capital have to create a new business model like, nowadays everybody's talking about ICO and new crowdfunding, etc. Right? So the fundraising method is also evolving. So we also have to put so much effort than start founding and doing that. That's
Would you like to say something on this? The third. Okay. So, Seema, can I pose you one question? In your experience as legal counsel, what are the legal aspects on exits that investors need to focus on or watch out for?
So ease of exits largely depends, and largely intertwined with the economic conditions in the market. But having said that, it's very important that the investors have very secure exit options mentioned in the contract. But that's not the issue. The issue is the enforceability. As investors and as representing both sell side and buy side, the maximum time that we spend during the investment process is the focus on the what are the exits going to be and how they're going to be playing out. One of the most important things that we've seen in the last 10 years is the enforceability of some of the very well negotiated clauses. For example, let's discuss the put option clause, where the promoter shareholder agrees to give the exit to the investor. Now, foreign investors, foreign venture capital investors have particularly had a hard time getting their exits through that particular clause. Typically, RBI has till 2014 frowned upon any kind of optionality clause. Just to explain to the audience, optionality clause could be a put option where the promoter himself is agreeing to give an exit to the investor at a pre-exit assured price, or a call option where he is agreeing to put his shares back to the investor. So largely, I'll focus on the put option where the problem is. The government of India does not think that this is, because this investment is in the realm of risk capital. When we bring optionality clause, or when we bring the risk assurance, assured return to the contract, they believe this is more an external commercial borrowing or a debt funding as against opposed to the risk capital. So for the promoter directors or promoter founders who are here, the intent more of the investors definitely is to have their capital assured through some kind of multiple exit at could be 3 years or 4 years or 5 years, depending on the sector. But the tussle has been very hard in this area, where most of the promoters take a defense of not giving the put option, enforceability to the put option, because under the garb of this particular pricing, prefixed pricing, assured pricing, is against the RBI FDI norms. And we've had a series of litigations where the investors have taken the promoters to the courts. They have got arbitration awards. And the interesting bit is that the Indian courts have finally come to the rescue of the investors, where they have said that what is being charged, what is being enforced by the investor is a breach of contract, not a put option per se. And enforcement of an award which is arising out of a breach of contract is enforceable. Yes, there is a FEMA violation. There is a FEMA non-compliance where the promoter had gone ahead and given some assured return assurances, which was not okay. But that per se will not come into the way of enforceability of an award, which is predominantly a risk breach of contract award. So that's an interesting development. So promoters who are agreeing to give, I've done a lot of sell side as well, where promoters agree to give and sign on the dotted line because they are in need of the funds, and we'll see the consequence of what these mandatory put option, call option, discounted pricing is, maybe 5 years down the line. Maybe we don't need the enforceability of these clauses. I think we need to get this mindset out, because these are enforceable contracts in some ways. And investors are very serious about enforcing these clauses when it comes to the exits. The other option when we have in a contract would be buybacks. Now, buybacks are by a company when the promoter is not wanting to give an exit. Now, buybacks again have a complication from the company law point of view because there are a lot of conditionalities where a company can actually buy back the shares of the investor and give him the exits. And most of the time, the company, the promoter-driven companies, hide in the garb of the company law non-compliances, such as we would give you buyback because your equity exit is more than 25%, so the company law comes into play there. I have defaulted in some previous loans, so therefore I can't give you a buyback. So there are a lot of conditions and restrictions even in the buybacks. Then it leads to IPO. Obviously, the feasibility of an IPO is based on the markets, the buoyancy of the capital market. So while from an investor point of view, what remains as a real exit is the strategic sale or third-party sale. And that may not usually give them the assured returns that some of the names that you've mentioned are some of the success stories. But the kind of exit that I've seen is where almost, the 70% of the investments are being written off. So these are serious situations which happens. So from an investor point of view, have alternative exit options and have the right to exercise these alternates through their affiliates and their nominees as well to sort of come around the FEMA regulations as well.
Yeah, sure. These investments are long-term investments and they carry with them their own set of risks, That risk could be pertaining to pricing, pertaining to choosing the right segment, the right time of entry, the right time of exit, and above all, the documentation part. So, thank you. And Abhinav, if you can please give us the perspective on Indian VC space. The rise in Asian connectivity has helped Indian startups disengage from hotels of Silicon Valley. What, from your perspective, are the attractiveness of Indian startups? And what distinguishes them from startups in other parts of Asia?
My question is very simple in one. It is the tech talent. Thick and qualified tech talent is really, outstanding in this country compared with any other global the regions. And I always believe that we have to divide into the two discussions if we think about if we talk about these topics. So one is the rising the domestic consuming appetite in India and the technology standpoint. It's totally different things. Of course, in some part it's related, and all of the unicorns like all the gentlemen mentioned is like ATM, Flipkart, and all that is the former one. That domestic rising consuming appetite to grab those. Actually, it tends to be commoditized. So that's the giant gameplay. So big get bigger, and the fear takes almost all game. So it's such kind of gamble. It's hard to compete with for the startup to giant. So I don't think the other regions investor from Japan or Singapore, China would like to join besides those three giants like SoftBank, Alibaba, and Tencent. So, for example, if you see the investor from the Taiwan, like Foxconn, MTech, the MediaTek, they tend to come to this country to recruit or acquire the technology talent or the technology IP itself around the semiconductor or the IoT AI spaces. Same as from Japan, for example, Sony, Hitachi, Toyota, Denso, stuff like that. So those companies are also looking for some new technology or the talented team around the IoT era. So obviously those, and also the important thing is that technology is a global play, but the internet service is a domestic play. So it's hard to go global. So the e-commerce tend to be stick with their own country. Rakuten in Japan, Taobao in China, maybe Flipkart maybe. So Flipkart never go to be Flipkart Japan, etc. Right? But the technology, it has to be the global player from the day one. So, and also the investor try to help them to go to their own region. And also we ourselves is also the kind of middleman, gateway fund to connect with those regional players from Japan or Singapore to Indian startups. So that technology talent is the answer for me.
Thank you. Thank you. Coming back to Ritesh, you told us that you were in this field since 2007. You were previously working with the firms. Those were established in 2006, 2007, and now you are there with a firm which has established recently in 2016. So how do you see the difference, and how are you managing now as compared to what was being done 10 years back?
So, very good question, Sanjeev. I think when we established our new firm a couple of years ago, we had the opportunity to actually think from the ground up. And what we did was we questions to ourselves, to our advisors, and to entrepreneurs as to how has the VC market changed in the last few years, and how can we build a firm that adapts to that change. So a few trends stood out for us. I think the number one trend was with respect to sourcing for VCs. How do entrepreneurs connect with VCs? If you look at maybe 5 years ago, the only way for a startup to get the attention of, to actually get funded, forget about the attention of VCs, was to go and parade themselves in front of the 10 VCs that existed. If you had a way to get a credible intro to the 10 VCs, phenomenal, otherwise too bad. Today, and as a result of that, almost every VC saw every deal. Right? We all, I don't think there was a deal 5 years ago that any of us at the table here would not have seen. In the last 5 years, that is no longer the case. Today, the best entrepreneurs don't go to VCs first. They go to a class of already established entrepreneurs for advice, for mentorship, for some capital, and for access to their networks. So, and these are all entrepreneurs that have emerged in the last 5 years. I mean, some of the people that we have been speaking about, the founders of Flipkart, Ola, Paytm, Taxi for Sure, Big Basket, some of these guys have become icons because the new entrepreneur identifies with them because they're roughly at an age that they were at of an age that the entrepreneur is 5 to 7 years ago, and they have built their businesses from the ground up. Yet we found that VCs in India were not co-opting this network into their own ecosystems. So what we decided to do was to create a formal network of these successful entrepreneurs to act as our eyes and ears. We got many of them into our fund as LPs. We have set up a formal engagement program with this group of entrepreneurs, not only to help us with deal flow, but to co-invest along with us, for us to co-invest in their angel investments, for them to mentor our portfolio companies, for them to help us with our diligence, and basically engage them as part of the VC process. We have now been doing that for a year. It began as an experiment, but I'm very happy to report that today approximately 25% of our priority deal flow, deals that we actually diligence, comes from this source. And this we believe is that number will likely keep increasing as this network deepens and as the deal flow of these founders themselves increases. The second trend that we noticed when we particularly compare Silicon Valley VCs with Indian VCs is that Indian VCs don't create any content. And that has, of course, that includes my partners and myself. That has been because we have had a relatively easy ride. We have never had to compete for deals. Like I mentioned, there are 10 to 12 VCs in India and Series A and beyond. And so we have never had the problem of catching the attention of the entrepreneur. But as a result of that, on the other hand, if you look at the top Silicon Valley VCs, whether that is Reason or Benchmark or Founders Fund, Particularly, I would say the VCs that have gotten established in the last 10 years, they have established themselves as thought leaders and have often created their brands purely based on the content that they have put out there. There are individuals in the VC space in the US, from Union Square Ventures, from Benchmark Capital, who have established their personal brands as a result of the content. So what we are trying to do, we have set up a content program to sort of plug that white space. But we are also finding the tangential benefit of creating a more transparent firm. So we, for example, used to always believe that our investment theses are proprietary. Where I think the opportunity is, let me not share that with the world, because that is my proprietary information. Well, it turns out that we are not the smartest human beings on the planet. There are enough other people who have the same ideas that we do. But instead, if we put out our ideas and sort of open source our ideas, the idea gets enriched as it gets more critiqued, as entrepreneurs add to those investment theses, other VC firms add to those investment theses. So our ideas become sharper. So what we have done through the content program is actually create a more transparent firm that leverages the broader ecosystem for refining our investment ideas. And the third learning for us over the last decade has been that VC is not a very scalable business. Typical operating business scales by adding people, and that happens when you have a pyramid structure. So the founders in a typical business, on day 1 the founder is doing everything, day 10 the founder is doing a few things, day 100 the founder is doing nothing but manage investor relationships and strategy. That doesn't work in the VC world, because the VC world is the VC business is a very on-the-ground business. If Kunjan and Arihant and I and Takeshi are not meeting entrepreneurs day in and day out and doing 5 meetings a day with the same vigor, knowing that 90% of those will not result in investment, we are going to be irrelevant within 2 years. We have realized that the biggest differentiator for a VC, all strategy aside, is actually their on-the-ground presence and their agility in making decisions. And so we are trying to create an agile, hungry, and on-the-ground firm. These have been a few lessons for us from the last decade of venture capital.
Thank you. Arihant, we would like to know, you are in a special position in a way that you are wearing 2 hats, one family office and one venture capital firm. So, if we look at these 2 investment vehicles, if I may so call, from point of view of investment and from point of view of returns, what is the difference and how do you manage?
It's a great question, because when you're wearing so many hats, you sometimes start wondering which one to put on when, right? To address your question, so the family office is largely involved in the public markets, but we've carved out a pool of assets that we want to deploy in the private space as well, because we really strongly believe that going in early with a lot of companies will help us create value in the long run. We do this in the fund format also, because we feel that we should have a little bit of discipline sometimes in the private checks that we write, and having the right partners that we can work with to be able to dig deep into certain specific domains helps us ensure that the investments that we're making also have an ecosystem around them that creates value and therefore helps them grow. So put it in simple terms, the funds that we have anchored and that we run always will get first right of refusal on deals that come in, especially that fit the theme of that fund, with both in terms of check size as well as in terms of the industry that they operate in. So for example, if there is an opportunity in, let's say, brick and mortar retail, which actually we have done through the family office, which doesn't fit any of these funds, we will certainly take a look at it separately and assess whether this is a good individual investment to make. I think from a thesis standpoint, I really fundamentally believe that that businesses need different kinds of capital along the journey of their growth and the industries that they operate in. If I were to look back and look at the services space that I'm from, I think there's a lot of value to be achieved within, still with, a services play that has, a linear growth trajectory, which will take time to sort of build brick by brick. But at the end of the day, will generate cash flow and will generate growth for the founders as well as the folks invested in that business. And this business may not be the best fit for a fund, because here you're dealing with a certain fund life. You're dealing with sort of out of the ballpark outcomes, or at least aspirationally outcomes that could be out of the ballpark. And this could be a business that's good for a family office, because this is patient capital. We don't have a ticking clock. We don't have, a lot of frameworks that we have to adhere to, a lot of accountability from external entities. This is really sort of the best long-term capital that you could probably get as a company. And I think that the other aspect to this is strategic value that a family office could add in a business such as this by virtue of being in an industry that has an impact in this business. So I think Kunjan will attest to this being part of a corporate house. I mean, there is so much other value that you can bring to the table aside from just capital. So here you have patient capital, you have capital that knows how to build a business, that can align itself with the company. I think there are certain plays which are very good for funds. Plays where, where folks like Ritesh and Stellaris or Sequoia or the other names that were mentioned earlier will have a deep value add based on the ecosystem that they operate in, based on their existing portfolio positions. I think you mentioned this about the existing entrepreneurs that you have backed and how they contribute back to the community. The global landscape that they play in, especially things like artificial intelligence, for example. I mean, I think it's very important to have insight into what's happening globally, what's happening in the Bay Area. And there are funds that specialize in these kind of companies that can add significant value in terms of technology, product, market access to help them grow. And in that sense, for these kind of companies, I think it's very important to get the right strategic partner with a fund. And this has been true for AI, for deep learning, machine learning, IoT, for e-commerce back a few years ago. And to be honest, I think the Flipkarts of the world have been able to grow the way they have been growing thanks to a lot of funds that they've been working with. So this is sort of how and I'll stop there for a second because I can keep going on how to balance these hats. But this is largely how I would sort of play between the two different roles that I have.
The patient capital point is very important. Then genuinely we become sort of long-term partners and entrepreneurs value us like that. But I think I know how Arihant and Amit also manage their business, and I think patient capital doesn't mean we can become lax about our investments. I think we come with the mindset that basically this investment has to deliver a certain sort of return threshold and be a profitable opportunity for us.
Thank you. Now, Seema, if I may request you to take us through the legal pointers for startup founders, looking for VC investments, or if there is something they need to watch out for.
Just before that, how many of us here are entrepreneurs, founders, startups? Okay, so this response is for you, and hear very carefully, because this is sort of the sum and substance of my 3 years of practice. So basically, as founders, as promoters, you need to, once you're going for your investment, you need to have a fundamental assessment of your investment in 3 critical baskets, I would say. The first basket is about when you are taking the investment and during the period of your investment relationship will continue, what are the rights and obligations that you're assuming as founders? Second basket is what is the exit option, what are the exit options and default optionality clauses that you're giving at the time of the exits. The third basket is what are the post-termination obligations that you're assuming. So I'll go one by one on these three critical aspects, and that will cover basically large part of your contractual obligations under any VC investment. It could be even a private equity or seed funding investment. It's typical for all three. In the first stage, what you need to be watchful is the VC fund coming with a minority stake investment but with a majority stake mindset. What does that mean? It basically means that the VC fund is asking for nomination rights on the board, is asking for reserve or affirmative voting rights, or quorum rights which are more representative or not commensurate with the investments that they're bringing in. To give you an instance, they are bringing in 20% of equity but needing majority control on the board. Is that okay? Because what you need to watch for is that what they pay is what they get in terms of rights. And so that there is no operational, apologies for the VC funds there, but what they, for instance that when they dilute their equity, their rights are being negotiated. Those renegotiations, suppose their equity goes down from 20% to 10%. Upfront in your agreements, it should be agreed that for 2 director nominees, you will become 1 director nominee. Further, what you need to understand is, are the anti-dilution or preemptive rights that the VC fund is asking under a contract, are they going to impede Series B investment? Is it going to be suffocating enough to get round 2 funding into the company? What are the obligations that you assume for those investments? Then what you need to understand is there are certain business plans on which the VC fund is based on, which is investing. Now, are you making those milestones as part of your breach conditionalities? And that's something that most promoters in their very eyes to get the investments make a mistake on, and that's very critical. When we agree on milestones as part of our business plans, they should be on a best endeavor basis. They should not be as part of, if these milestones are not met, it becomes a breach conditionality, because once that becomes a breach conditionality, a lot of default exit clause kicks in. So that is something that you need to be very watchful about. What are your reporting arrangements? What you need to be watching out against is that are your investors going to be operationally investing in the company on a day-to-day basis? Is there going to be an operational control, which is much more required than what an investor should be doing? I've handled quite a few arbitrations and litigations where with the promoter between promoters and VC funds and private equity funds, where the VC fund or the private equity fund decided to now tell the promoter how to operate the company, what are the business decisions that he needs to take. Now it's great when the VC fund is investing time and energy and doing the groundwork with the promoter as part of a team. But it goes to a second level if they start dictating the terms and conditions of how the operational decisions are going to be taken. And that has happened, and it happens in quite a few investments that I've seen have gone wrong. The other things that you need to be careful within the first stage of the basket is what are the transfer restrictions that you're assuming on yourself? Is there a lock-in period which is fairly required by all investors? But what are the rights in terms of transfer restrictions that you're assuming? Is there a right of first refusal, which is fine, but do you also get a co-sale right when the VC fund is divesting? Do you also get a right along with them? Negotiate your rights well. In the second basket, which is coming out of the exit options, be very careful what are the exit options that you are giving. So while the investor would ask for standard IPO after a particular number of years, they would ask for buyback of shares. What you need to be watchful is, are you giving mandatory put option? Now, put option and mandatory put option are contractual obligations which are absolutely enforceable. Are you also agreeing for a drag-along right in case of a third-party sale? Drag-along right and mandatory put options put a tremendous pressure on the promoters when they are divesting, when the investors are divesting, because it obligates the promoters to give the exit to the VC fund at a pre-assured returns, and B, it also pushes the promoter out of his own company, and that happens a lot of time when the promoter is being forced to quit and move out and sell, co-sale along with the investor because the new strategic investor is wanting 51%, and which put together comes through the promoter equity. So these are the things while you're looking at the exit option. Then third, within the second basket, what you need to be careful is, are you negotiating your default conditions very, very carefully? Is everything a default, or critical issues are the very material issues are default? Now from a legal standpoint, as a lawyer standpoint, it's very difficult to define what is material and what is not material. Nothing can be predefined. But things like, as I just said before, things like whether not meeting the milestones, not meeting the business targets that you had agreed on a good faith basis, are they going to be your conditionality for being a default? Now that's a very dangerous place to be, because most of the business plans do not work. Excel sheets in 40 to 50% times do not meet exactly what they are written there. So be very careful on what are the default conditions that you are assuming. The reason I'm saying that is because once you assume the default conditions, there are certain consequences of the default. Typical consequence could be the options exercised by venture capital funds. It could be call option at discounted price, which basically means where the promoters will be forced to sell its equity at a discounted price from the fair market value, which could be very painful for the promoter who has been running the firm, who is sort of generated the firm and led the firm, and is being exited out on that too at a discounted price. The other option would be where there is a put option given by the VC fund to you to buy the shares at an X multiple of the actual price, and that also put tremendous pressures on the promoter. The third aspect of the investment, the third stage, is what are the post-termination obligations that you're assuming? What are the indemnification rights are you assuming? Are you assuming unlimited indemnification rights? Is there any cap limitation of liability concept being introduced into your contract? Be very focused on your indemnifications, because these are enforceable rights which will go a long way in putting a lot of damages on the promoter in case of litigation happens. Then what are the non-compete and non-solicitation obligation? I think that's one of the most sort of negotiated rights by the investor, fairly so, because they do not want you to compete with the investor if the investor is continuing in a fund and you are the one exiting. Non-compete should be reasonable. These a lot of times, the mindset that I've seen working very closely with the promoters is that they assume that all non-competes are unenforceable, and therefore assume kar lo kya farak padta hai, because it's not going to be enforced. That's a wrong interpretation. Typically, non-compete are unenforceable between two unequal partners. But it's not an absolute case where the non-competes are not enforceable. If they are limited in their applicability, if they are restricted in their applicability, they will be enforceable. So be very careful that you do not vote yourself out of the very business that you are equipped to handle and have experience in. So these are the three things that you should be very careful while doing the investment.
Thank you so much. I think indeed a very useful information. Now, next question is about the changing role of venture capitalists. A lot of discussions we hear happening around here, as I was also saying, about the timing of investment, about the strategy, which segment to invest, which not to invest. But not much discussions are happening between what is happening between entry and exit points. So, if we'll have a quick comments on this, please. I think we are running short of time. So, starting from Ritesh.
So very quickly, I do think that the role of the VCs has evolved significantly in the last decade or so of venture capital in India. So I think to me the first change has been that overall the role that the VCs have assumed has moved from monitoring to support. I don't think there is a market for venture capital in India where all that the VC does on the board is monitor whether the business plan objectives are getting met.
So it's a great point, because what we do at RPG Ventures is also, like I said, incubate businesses, right? So honestly, this whole sort of working with businesses to build them out is literally part of our DNA, and this is a big part of our role. We launched a couple of businesses which are our own businesses so far. For example, a couple of years ago, we started a business called Seniority. We sell products for senior citizens, lifestyle and community related, and that's our own business, right? So essentially, it's like me, my colleague others, and in the audience as well, working with the founders over there and just building it up. Because that becomes so much part of our DNA, to sort of build out a business and get sort of the co-founder to founders of Seniority, that sort of spills over to the rest of our company, the rest of our investments that we've been making on the tech and healthcare space as well. And the roles are sort of really diverse. I think Ritesh has covered them all in terms of how we work with these people. It's not only about sort of finance, it's recruiting, it's troubleshooting, it's literally sort of playing the role. If they were not there, can you sort of step into the shoes of as a third co-founder and sort of speak to potential business partners and stuff as well. So that's really sort of that's what we do, and that's because the philosophy of the group that we work for is that to build businesses, right? And it's interesting because it's like I probably didn't do as much in my previous roles, but over here it's been a good learning experience for me, and it just it's a new sort of aspect that I've been there shaping up as well, and I think, as Ritesh said, is an important aspect of venture capital.
Anything specific, if you have seen, or any one of you, VCs see to it that there is a synergy between the investee companies, or putting in place some policies or strategies so that there is a synergy between the investee companies? Have you seen that factor playing? No.
Yeah, so I mean, quick 30 seconds. Synergies are from the perspective of sort of co-learning, right? So it's like one portfolio company learning from the other. So we facilitate that quite a bit as well, and it's very useful. It just sort of helps companies get up the learning curve very quickly.
Ebihara, sir, your comments, please.
About the VC role, as those gentlemen says, that fundamentally, I don't think it hasn't changed. If I dare to say, corporate investor is jumping this venture investment nowadays, so that I begin to think maybe we better to take care of the bit more corporate investor side. To connect with the startup innovation and corporate investor, how to deal with that as a middleman. Venture capital can have such kind of role, I believe. And talking about your question about the synergy between the investees, not about the synergy, because we are the very early stage investor, not about the business synergy, but most of these early stage startup founders have a common problem or annoying. So including the very mental and the psychological things. So we sometimes do kind of a Rebright kind of things, and then they share what they're annoying and the worry about, and they discuss about day and night so that they can improve their the way of the thinking how to deal with the problem. So that's if I dare to say that works very much.
Thank you. And coming back to Seema, what in your reading has stopped the government from completely resolving the vexing issue of angel tax with respect to genuine startups?
Okay, so just for the audience, angel tax is something that the government taxes on the companies, unlisted companies, if they receive premiums and share consideration which is in excess of the fair market value. The fair market value is 100 and you're getting your investments from the VC funds, non-registered VC funds at 150. The 50 rupees gets taxed as an income from other sources. There are certain exceptions which do not get. AIF registered VC funds do not get tax if the investments are coming from there, or non-resident funds or investors. The third one which the government added was recently in 2016 was the startup funds. If the startup funds are receiving funds, they will not be taxed from in this particular category. But the startup funds which they have defined is very limited in their implement, which is the startup funds which has the status of registered status fund from the government of India, which is you need to be 7 years and not more, and 10 years in biotechnology, should not be having 25 crores of turnover in any of the financial year, and should be in the innovative space. Not everybody is in that space, and so a lot of investments coming from HNIs, coming from unregistered VC funds still get taxed if there's more than the share premium, because initially the fair market value of the startup investee company is nothing. The reason it has not been completely dealt with is because government, the income tax believes that this is their way of avoiding laundering of money. They believe that the share premium is a means of conversion of black money into white. So that's why they think this is an anti-evasion tax rather than angel tax. So they want to continue with this so that they are keeping a sort of control on the conversion of black money into white. That's the reason they don't want to take it away.
Thank you. Now, before we go to the next question, that would be the last question. I would request all of you to be ready with the questions that you would like to pose to our esteemed panelists. And the last question of the day is to all of you. If there is one change that you would like to see in the Indian startup ecosystem, amongst entrepreneurs, investors, media, service providers, what would it be? To start with, yes, we play from center.
Let me jump in here. I think one very strong view I have is that we don't do enough as an ecosystem the way the West does in terms of corporate meets academic meets government meets investors. And I think the only way that we will see true breakout innovation out of India is if we have this coalition developed. So just to give you an example, we're from Ideaspring funding a company that is involved with system level simulation for electromagnetic interference, right? A lot of words. But really it helps you decipher how sensors within devices kind of interfere with each other. So think about self-driving cars and how critical that is in terms of different kind of sensors talking to each other and making sure that the right messages are passed on. And this is a play in partnership with a team from Indian Institute of Sciences, with a large industrial player, within this space, a multinational player, and us. And I think that, if it was just us, to be honest, I don't even know whether we will be able to understand this or be able to take the risk to invest in this. But with the support structure that there is, this entrepreneur has got the chance to kind of take it to the next level. I'd love to see stuff like this in health sciences and life sciences, for example, or rather health tech and life sciences. Because I think there's a lot of problems we can solve with 3D printing of cell tissue that can be used for sort of toxicity research, of providing kind of medical services or tech-enabled medical services in rural areas. All of this needs a government support especially and support from a lot of larger players that are willing to throw in help to these companies. So that's one thing I would love to see change. Certainly there has been some evidence of this. IIT runs with Intel, the Science Incubator, which is out of IIT Mumbai, and there are a bunch of other such initiatives that we'd love to see.
Thank you, Ritesh.
So my wish list, how many hours do we have? I'll just mention one thing which I see as I would say my biggest problem today. It is the relative lack of availability of growth capital in India. There are plenty of funds like ours who provide Series A capital. There are, as a consequence of the early stage funds getting larger, I believe the Series B stage is relatively well funded. But between that, a Series B round of let's say $15 million or so, and a Series D or E round where the likes of SoftBank and Alibaba and Tencent get interested, that is at 100 million plus round size, there is a massive gap. There is probably no investor that specializes in tech growth funding in India, and I believe that's a massive impediment for the growth of our startups. So if I were to change one thing about the ecosystem, I would wish for larger capital deployment in Series C and beyond.
Thank you. Kunjan?
My wish for all the entrepreneurs are just think big. We come across so many companies, and that's our job, to sort of meeting companies and go through business plans. And at the end of it, I'm just like, what's the market opportunity over here? And just stumble upon even getting $100 million or $200 million. So, I'm just like, think big, just sort of expand your horizon. And thinking big, and by say $1 billion market doesn't have to be that you have to go outside India. There are 1 billion people in India as well. So, if you can create sort of products and solutions meant for 1 billion people in India, as more and more of them come online and stuff, so be it. But just sort of just expand your horizon, because large market opportunity is something that everybody will look for. Any investor will look for. Everybody is saying this plan to do it as well. So that would be it.
Okay, so mine is very simple. I don't have any complaint about the ecosystem itself, but if I dare to say that tax is a very big problem. As a foreign VC, raising the fund here in India is very tough, almost impossible. And the allocation to the startup is also very hard. So I don't want the startup has to be very easily set up the company and then easily get the fund, not using by the mortgage structure, Singapore structure, such kind of things. So that's the only hope. But other than that, from my vision, the Indian startup ecosystem is perfect.
Just to add to what you said, I think it's time that the angel tax should be done away with. But I have a second wish as well. I think if you look at the ecosystem of the Indian VC funds, 90% of the funds are coming from outside of India, and the government came out with 10 crore 10,000 crore funds of funds in 2016. And it was announced with a lot of fanfare, but it hasn't taken that kind of bandwidth that it was supposed to have. And the primary reason is that the government decided to invest into the AI venture capital fund as an LP, as a limited partner, and they agreed to invest up to 20 to 30% of the fund capacity of a venture capital fund. The only problem when the government they came up with the stringent regulation that these VC funds, where they will, as government will invest, they would come out with a restriction that the VC funds will then only be allowed to invest in other startups which have been recognized and have obtained the status of a startup. And the VC fund, if the startup needs a Series B fund or additional funding, if it has crossed the 7 years period, it cannot make another portfolio investment in the same company. Now, a lot of these restrictions have dampened the spirit of the VC funds, Indian VC funds, to receive these funds from the government. I think that needs to change if this present government really needs to make a headway with creating Indian LPs and VC funds.
Right, thank you. So with this, we come to the end of our panel discussions. Now it is on you, and any questions are there, you may ask our esteemed panel.
Hello, my name is Ritesh, basically from Travel Goods, from Destination Management Company. My question to Mr. Ritesh, how 2018 is key important for destination and travel company related to PE investments, basically?
I was hoping you could enlighten us about that. I'm certainly no expert in destination management, but very broadly, I personally have been investing in online travel for the past 10 years. And every time we have made an investment and it has worked out, we thought, okay, online travel seems to have worked already. But every time we find another niche within online travel that grows and becomes very large. So my past firm, Helion, had invested in Make My Trip. That became very large. We thought, acha, online travel ho gaya. Then we found Redbus. Then Redbus became large. Then we found Taxi for Sure. Taxi for Sure became large. Right now we are looking at first and last mile transportation. Hopefully that will become large as well. So broadly, I still think there is a massive amount of runway in business models in online travel. The world over, it has been one of the first categories of online adoption. While I don't know your business or destination management as a concept, I'm broadly extremely bullish on the continuing potential of online travel.
Thank you.
Anyone else?
What a wonderful panel, and I have enough and more. So I'll probably start from Seema unless somebody else has a question. This morning we had a couple of discussions around cryptocurrencies and so on, right? And there's one company which apparently from India has done an ICO, right? So I don't know if you've heard of this concept, and pretty much the investor on stage called ICOs a scam, internet coin offerings, and there was a lawyer who was saying, maybe not kind of thing. So what do you have a view on this, cutting edge kind of concept, and throw some light on that?
So cryptocurrencies is very interesting. We do a lot of work in there. We're presenting a few cryptocurrencies in India, and they're on the wrong side of the law right now. We're having some investigations. But cryptocurrencies, government, I recently attended a meeting with the government of India, senior official, and they're equally as confused as the rest of the world. They do not know how to tame cryptocurrency. If you see the history of the government's stand on cryptocurrency for the last 5-7 years, they've been coming up with advisories on cryptocurrencies. From 2013 onwards, the RBI has been saying we'll come up with a regulation to sort of regulate cryptocurrency. But in the meantime, all investors are going to do it at their own risk. It's not a legal tender. It's not accepted as a currency. We do not encourage people to waste their money on cryptocurrency, and we'll be shortly coming out with a regulatory advisory on that. That was 2013. In 14, they came up with a blockchain technology white paper, and they decided, as a technology, it's a very important technology. We should harness it for other investment vehicles. But there have been a series of advisories that we've been giving, but every time they are, stopping short of banning it, irregularizing it, and there's a tremendous amount of interest. I at least get 1 or 2, mails a week. From generally people wanting to set up cryptocurrencies exchanges, wanting to come to their cryptocurrencies big houses from Singapore, Hong Kong, they want to come to India, and they do not know what the government stand is. Recently in 2017 December end, they came up with a policy that we have set up a committee of high-level committee of government, and we are analyzing the legality of cryptocurrency. They believe that cryptocurrency is definitely not going to be illegalized, but they also not regularizing it, because it's a ghost which is invisible, I would say, because the way it is managed and operated is pretty opaque. So government is really out of its depths how to sort of regularize it. So when we met this government body, they said that we have serious sort of problems with the concept itself. We do not know where to tax it. While the regulation can be brought in, like US to put capital gains on cryptocurrency, but the fact of the matter is cryptocurrency is operated in an opaque manner. It's not visible. The only way you can make it visible is to rate the exchanges, which the income tax recently did, and send thousands and thousands of notices to the guys who are actually operating in the exchanges. So I cannot much comment on ICOs, but that's not what I've really looked at. But cryptocurrency is something that the government is really out of its depths, and they have set up a committee which is high level looking into it, and they're working on it, but I do not know how many months and years they will come up with a policy on it.
Thank you. Any other questions? Because I keep them busy, so if not. So my next one, unless there's any other question from the audience, is to Arihant. We keep hearing about this, it takes 10 years to build a business in India. And that's your GP hat. Where your LP hat, you give these guys 5 to 6 years, of money to, exit from, and where are the exits, So, one line that you mentioned that it typically takes 5 to 6 years, or even 10 years to build a business anywhere in the world. But, we see a Google going 0 to IPO in 5 years, so what's going to change? Are you going to give more time to VCs to exit, or are businesses in India going to provide exits faster than they used to? So that's really the question. So on the time frame.
So I think that whether it is a question of, so there's a question of value and there's a question of exit, and they could be a little bit different, right? You're right, Google did go IPO back in '95, but if you look at it, they took a lot of time to build value in that company, which today is of course immense, but they've been in business for a couple of decades or more than that, and so has Amazon for that matter. So these are very large behemoths which have gone public and therefore are liquid, but also continue to build business as we go along. When it comes to exits in a certain set time frame, I think everyone knows that this kind of, you have either IPOs or you have strategic sale, and I think that for a company to go IPO today in India takes quite a bit of work, and I think Seema will be able to opine on this better a little bit, but quite a bit of work and quite a bit of regulatory approvals, which is why a lot of the bigger unicorns also haven't been able to go IPO, and in fact they go IPO on the NASDAQ or the NYSE before they would go IPO in India. The strategic sale market is sort of still developing. So while Google and Facebook and Amazon just bought a doorbell company for $1 billion valuation just this morning that we read. I think a lot of this is happening outside the country. A lot of issues with IP, with tax, as Takeshi was talking about. So the intrinsic or the indigenous strategic kind of play isn't strong enough. So where does that leave us? We can either sit and hope for exits to come magically within 6 years, 7 years, 8 years, or we can concentrate on building value in good companies with a long-term approach. And I think I would pick the second rather than just chase exits and hope that I'm going to get a quick buck on the money that I invested.
Thank you so much. So, is there a final question for the day? Otherwise, I'll take that myself. Are you guys sure? Fantastic. Thank you. This last question is to Ebihara-san. You talked about SoftBank, investments, and you said Flipkarts of the world may not really go to Flipkart China, Flipkart elsewhere, but the way the vision fund of SoftBank, the sheer size of it, 100 billion nearing, they seem to be investing to make companies regional at least. So, for example, we saw post their investment, Ola becoming Ola Australia as well, right? So, their thesis seemed to be that the Flipkarts do not have, India is not big enough, especially the kind of money that they're putting to work. They have to replicate and make even Flipkart bigger. The possibility, but at least in the case of Ola, we've seen them. So, are you seeing more a regional play? In your own portfolio, it could be different. You probably can't speak for SoftBank. But are you seeing this kind of at least regional companies being built out in your own portfolio, or other examples of companies coming from other parts of Asia into India? The whole interconnectivity in the Asian region.
Yes, thank you for a very good question. For example, SoftBank recently helping the WeWork to build the WeWork Japan, for example, after their investment into that company. And also the Uber tried and re-enter. I think it's to go and try their temptation to go into the market together with the SoftBank help. So the business, which is not existing to the other region, makes sense to go to that region. Right? But the e-commerce is everywhere, so it's ridiculous to tempt such kind of attention. So the important thing is that even though the internet service to build the new things, which is original, is pretty important, I think. So for example, the Alipay was very different from the PayPal, for example, at that moment. So that the Alipay kind of the UI is now dominant to the outside, almost every region in the Asian countries, including Japan. So such kind of play can possibly work still. But again, so the normal other kind of copycat thing is very hard to be the regional play. That's my thoughts.
Thank you so much, and thank you so much, Sanjeev ji, for moderating this panel in a very organized and a lot of homework done, and we got a lot of value out of this. So I would request you to have a group photograph at this point and actually talk a bit more about the panel. Thank you so much, for the wonderful panel.
Thank you.
So I think the folks in the audience who kept back the questions, you should catch them offline. We have some more time over coffee. We should network with them. So in fact, as I was talking about, the panel and calling the investors, a bit jovially as the dark side, right? So as listening to all of these guys talk, I know how these guys are entrepreneurs too. So I would really, appreciate that point of view, and as we interact with them, that these guys are no less entrepreneurs than we entrepreneurs think of ourselves. With that thought, I would love to thank our sponsors for this conference, SBI-SG Global Services, Economics Law Practice, as well as Basis Fund Services, Avalon Consulting, HSBC, and LexCounsel. Thank you so much for supporting this event, and all of you have a good back home. Thank you. Bye-bye.